before we get started also, just a little housekeeping I need to do, and let's get that out of the way. So I'll put up this two risk disclaimers and warnings, and may I please request you to read these carefully. And there are two of them. I'll put up each for about 30 seconds or so. And may I also highlight that by continuing with this webinar, you are confirming your agreement with its content. So this is the first of the two. This is the one from Trade with Precision, and there'll be one that I'll put up after this for about 30 seconds from Nadex. So I'll put this up for about 30 seconds. Thanks. And this is the one from Nadex. So I'll put this up for about 30 seconds as well. Okay, so let's get started. And for those of you who decided to stay on, welcome. So the agenda for today, before we get to the agenda, I'd just like to introduce briefly the two organizations involved in today's webinar. Nadex, of course. Nadex is a derivatives exchange, and just like to highlight that they are subject to regulatory oversight by the CFTC. So this is a regulated industry, and it's regulated for your protection. Nadex was formed as an entity as of 2007 and is part of a larger group which is involved in derivatives internationally, known as the IG Group. The operations of Nadex are out of Chicago, which, of course, as you all know, is the hub of futures and options market and activity in the US, but I dare say not just in the US, but in the world. On all the contracts that we'll be talking about today are basically settled in cash. So there's no deliveries involved, which means there's no risk of having a mountain of corn delivered to your front yard. Now there are over 25 global markets that we can trade using the contracts or the types of contracts that are offered by Nadex, which are binary options and spreads. And in today's webinar, we'll focus on a trading strategy that you can use to trade both binaries and spreads. Just briefly about Trade with Precision. Trade with Precision was created by Nick McDonald, who's our founder, and it was created in 2006 as a provider of trading education for retail traders. We are an international team of traders, and we provide education for some major brands of exchanges and brokers around the globe. So we teamed up with Nadex in 2011 to bring you some specialized education around their products. So Trade with Precision is a company that's run by traders, for traders, and we are specialists in trading strategy education. Also like to highlight that you can trade Nadex products on all your devices, including tablets, mobile phones, and of course your PC. In all these devices, you can search for products and pull up charts, which you can customize with multiple time frames and indicators. Your access is completely secure, and you can monitor and you can review your positions and account balances at any time as required. So That brings us to today's agenda. We'll start by talking about some of the, well, critical and quite basic trading errors that are made by traders, especially traders who are just starting out on the trading journey, and how we can actually overcome them and how we can cure them. We'll look at how risk can be managed and how professionals do it, how professionals manage the risk. Then we'll spend quite a lot of time talking about technical strategy. First of all, why you must have one. Secondly, the difference between trading strategy and just bare-bone technical analysis. And thirdly, we'll discuss a specific strategy that we use every day, that I use every day, that all the traders at TWP use every day in our trading rooms. And lastly, we'll talk about the advanced education courses that are available for Nadex, which can help you to take your trading to the next level. So what are the 7 critical trading errors that I was just discussing in the agenda? Now, the first of these is trading without a strategy. So what does that mean? That means when one trades without having any rules which govern the entries, the exits, where to set your stop losses, etc. That is basically trading without a strategy, because that's what a trading strategy is all about. How to enter a trade, when to exit a trade, and where to set your stop losses. Second is using technical analysis in its traditional way. And well, the thing is, when technical analysis is used traditionally in the way it's written, or in the quote unquote textbook style of technical analysis, then that does have some associated problems with it. And we'll talk about this in this webinar today. So what we need to do is we need to apply technical analysis with a fair bit of pragmatism, and we will show you how, and we'll discuss this in today's webinar. The third is, well, not being able to, set one's stops properly. So if we don't know how to do that, we don't know how to enter a trade, how to manage a trade, when to exit a trade optimally, and we'll discuss some of this in today's webinar and in the advanced education series as well. Okay, and this is a big one, guys. This is about looking for the holy grail of trading. By the way, there is no such thing. So there does not exist such a thing as a holy grail of trading. There's no such thing as a black box. And the only thing that makes one successful, unfortunately, in trading is just knowing the basics and applying the basics consistently. And what do the basics consist of? The basics basically consist of a proven strategy. So having a strategy and applying the strategy consistently, and applying the strategy flawlessly, and applying the strategy with a lot of discipline and emotional control. And that's what makes one successful. So the fifth mistake, of course, is thinking that trading only consists about picking winners. Well, I wish that were true, but unfortunately we live in the real world, and we do have losers. Everybody has losers. I have losers. All traders have losers. The best traders have losers. And not only do we have losers, unfortunately, at times we have a string of losses. So the important thing is to be able to recognize that, look, losers are going to happen from time to time, and also to be able to bounce back from a loss or even from a string of losses. So to have the mindset to bring to bring to the table the positive mindset that allows one to do so. And this is very, very important, guys. This is more important than probably a lot. And then the mental part of it is the mental part of trading, and you'll hear a lot of people say this is probably more important than the numbers or the reading the charts part of trading. The other mistake that a lot of people make is to focus overly on a particular market or a single product. And what one needs to do is obviously have a portfolio of product that one works with. So while it's not a bad idea sometimes to sort of focus on a segment of the market, but it's still important to have a portfolio of products that one works with, especially a portfolio of products which are not sort of very highly correlated with one another, and that's what allows us to manage one's risk. And I spoke about this just some time back. The seventh mistake, and actually sometimes the biggest one, is a lack of emotional control and discipline. Well, there's one bigger one, and the biggest one is actually not to recognize or acknowledge that these 7 critical errors or mistakes are actually made. And because once one acknowledges that these errors can be made, once one accepts that, yes, we can make these errors, and one can then take the next step towards rectifying oneself and working on these errors. But without accepting it and internalizing the fact that, well, one can make these 7 errors, well, that makes it almost impossible to at least work on them, recognize them, and work on these errors. So what is then the secret to trading success? So, well, what is it? What it's not? What trading success is not about is it's not, and as sort of dichotomous as it may sound, it's not really about picking winners. So, and there are 2 aspects to trading success, and they're really quite basic, and they are not, they're not secrets at all. So, and what are these 2? So the first thing is risk and money management. So it doesn't sound like a big secret, like I said, but it's obviously a big thing. Why? Because risk and money management is what ensures your longevity in the game. And the longer you stay in the trading game, the longer you're able to trade, the more successful one will be. And the second thing I just spoke about in the last slide, and that is emotional control and the trader's mindset. So if you read any book at all on trading, I recommend 1 or rather 2. Both are written by a guy called Jack Schwager, and what he's done is he's interviewed about 100 of the world's top traders in the 2 books, or between the 2 books, and then he summarized his findings of his interviews of these world's top traders. And the 2 things, there are a lot of differences. So the traders come from different backgrounds, they have different levels of education, etc., etc. But the common thing that runs through all the 100 traders, the top 100 traders in the world that he's interviewed, is these 2 things. The first is that they manage their risk and they manage their money quite conservatively. And the second is that they talk a lot about discipline, and they talk about traders' mindset, and they talk a lot about emotional control. So there you have it. Those are the 2 secrets to trading. And if actually one is able to bring these 2 to the table, one automatically increases one's chances of success. So how do professionals manage the risk? And I just spoke about this in terms of, sorry, just getting a drink of water. What's mentioned in Schwager's book. And the first thing, of course, is that one needs to have a strategy. So it is a very, very bad idea to trade without having some sort of a documented strategy in place. And having had the strategy, the second thing is to execute that strategy flawlessly. And what allows you to execute the strategy flawlessly? Well, it's just having the discipline to do so. So it's all about emotions. It's being able to control one's emotions, and controlling one's emotion allows one to execute one's strategy flawlessly. And of course, the 2 are linked. So the more a strategy is executed flawlessly, the more confidence one has in the strategy, and that helps with the discipline part as well. So it becomes sort of a self-fulfilling prophecy, and then that helps consistency and trading success. The other thing we spoke about is money management and risk management. And one of the basic principles of money management and risk management in terms of staying with the game is not to risk more than 1% in any particular trade. And we'll talk about this a little bit more as we go along in today's webinar. So how does trading with Nadex help you to manage risk? Well, the first thing is because you're trading binaries or you're trading spreads. So your risk and reward are therefore capped. Both upside risk and downside risk are capped. And if you look at the order ticket, and we'll look at that in one of the slides that are coming up in the next few slides. So you'll clearly see that your maximum profit and your maximum loss is clearly marked out on the order ticket. So, and that helps you to know exactly how much money you're putting at risk or how much money you're likely to gain, and therefore that helps you to manage your position size, manage your risk, and cap your risk to 1% per trade. Now, the other thing is that most Nadex contracts are under $100, and that's the amount of your risk. So that's fixed, and it's $100. It's usually under $100 a contract. So you can cap your risk. You know exactly how much you're risking, and it's also quite affordable. Now, one type of risk that one needs to be aware of, especially when trading options, is time value risk. Now, you can make time value risk work for you, and you can make it work against you. So in the case of binaries, how do you make it work for you? Well, simply, first of all, as an example, you trade during periods when the market is not very volatile. So if the market is relatively quiet. And what that allows you to do is, for instance, if one is trading when the market is relatively quiet and one is trading a contract that is in the money. What is a contract that is in the money? A contract that is in the money simply means a contract that where the market price is above the strike price in the case of a long position, and the opposite in the case of a short position. So if one is trading a contract that is in the money in a relatively quiet period, then that implies that the market doesn't have to move a long way for the option to work out in your favor. And that is how you can use sort of time on your side. The flip side to that is, of course, a contract that's in the money will be more expensive than a contract that's out of the money. And the flip side to that is to trade a contract that is out of the money in a period that's relatively more volatile. Why? Because the higher volatility or the higher implied volatility implies that the market may move. There's a higher probability that the market will move in your favor given enough time, which of course, so the advantage of trading a contract in a period of higher volatility, which is out of the money, is that these contracts are usually cheaper, so therefore the reward to risk ratio is higher. So if this is not very clear, especially for people who are starting out, please attend our binaries options webinar, where we talk about these in a lot more detail. I already spoke about money management and money management risk, and the goal of money management obviously being longevity in the market, ensuring survival, protecting your trading capital. So then this should be the first rule for any trader. The first rule for any trader is to protect one's capital. Why? Because if you're out of capital, basically you're out of the game. So you're no longer able to trade. And just to ensure survival and to ensure that you're successful, one needs to ensure longevity in the market. In fact, I'm just putting down a quote here from a gentleman called Alexander Elder, and he's one of the most successful traders in America. He's actually a Russian gentleman who migrated to America in the 70s. He's a doctor. He's actually a psychologist and a psychiatrist. Sorry, and he's invented a market indicator or momentum indicator called Elder Ray as well. And the thing he says is that as traders, we need to watch our capital as closely as a scuba diver watches his or her air supply. And that's so true, because for us as traders, our capital is our air supply in the markets, and we need to watch it very, very closely. So here's just an example of tickets from the Nadex platform, and on the left you have a ticket which is a ticket for a spread, and on the right you have a ticket for a ticket which is a binary option. So as you can see, the spread here in this case is for US tech stocks with the index, and what we are saying on the call that we are making is whether the market is going to be between 2110 and 2310 as of 4:15 p.m. on the 9th of September. And on the right side is a ticket for a binary contract, and in this binary contract the call that one is making is whether copper, the price of copper, is going to be above $405.5 as of 1 p.m. on the 9th of September 11. And the bid-ask prices that you see below, so the 2210 and the 2212 is the binary prices or the spread contract prices, and that's the prices at which you buy or sell the contract. So the price on the right is the price that you buy at, and the price at the left, on the left, is the price that you sell at. And so if you buy a contract, that means you believe that the floor ceiling rate, like for instance for a spread, that it's going to be between 2110 and 2310, and if you sell, that means you believe it's going to be outside that range. Similarly, when you buy a binary contract at 405.5, what the call that you're making is that the price, if you buy it, the call that you're making is that the price is going to be above 405.5, or in this instance where the example shows one selling. So basically what we're saying is that the price is going to be below 405.5, and you can clearly see the maximum profit and the maximum loss is clearly marked out on the ticket itself. So through that, you know exactly how much money you're putting at risk and how much money you're likely to gain, and that allows you to manage your capital and manage your risk effectively. So one question that a lot of people ask is, can you still profit by risking just 1%? And the answer to that question is yes, because trading at the end of the day is not really a get-rich-quick scheme. So trading is about being able to apply one's strategy consistently, executing flawlessly, and making money consistently. So, a get-rich-quick scheme is something like a lottery, but trading is not one. So the other thing is, just think about it this way. Like, look, if one were to consistently net 1% per week, so that's 4% a month, which means 48% a year. And I'm sure 48% a year is the kind of returns that nobody would laugh at, and which no bank ever pays. And even if you think about half that amount, so if one were to net 2% a month, then that's a 24% return, which you will all agree is quite high. So can you still profit by risking just 1%? Yes, you can. If you have a strategy and you apply your strategy consistently, and you have the emotional discipline to execute flawlessly the strategy that you have, which is a proven strategy. And managing your risk, of course, is the most important. And this is what I spoke about earlier, which is trading is all about making money slowly. So it's not a get-rich-quick scheme. Let's now talk about technical trading strategy, and just let's talk about the basics first. We will then talk about the different ingredients that go into making a technical trading strategy, and then finally we'll put together or construct a strategy which we can apply to the markets. So trading strategy versus technical analysis. Well, it's not so much technical analysis versus trading strategy as such, but the different components of technical analysis. So any trading strategy actually comprises of several facets or several components or several tools of technical analysis. And when we talk of technical analysis itself, what we're talking about is the different facets of technical analysis and the different tools of technical analysis. And these tools of technical analysis are the ingredients that go into the strategy. And the strategy is actually the recipe which comprises of the various tools or the various ingredients of technical analysis. So just like if you're baking a cake, you need several ingredients. So you need flour, you need sugar, you need egg, you need yeast, and you need to combine them together in the right proportion. Similarly, with a trading strategy, you need to take several ingredients of technical analysis and you need to take them and combine them together in the right proportion so that you get consistently profitable results. And so that's the sort of difference between technical analysis and trading strategy. Well, because a trading strategy comprises of several tools of technical analysis. Now, one thing that we need to note is that technical analysis alone does not make us money, but what makes us money is a trading strategy. So a trading strategy that combines several facets of technical analysis is what makes us money. Okay, so just like to check if you guys can still hear me, because I don't know, I'm not getting too many questions. Usually, the audience is a little more engaging and ask questions. So may I quickly request if those of you, okay, thanks guys. So, okay, I've got feedback from people that you can still hear me. So thanks for that. So, I was just talking about technical analysis, and what doesn't make you money is not technical analysis or the ingredients of technical analysis, but strategies in which we combine several facets of technical analysis. Right. Now, I spoke about this a little bit earlier in terms of traditional technical analysis and things one will read about a lot in technical analysis textbooks, and sometimes technical analysis can be a bit heavy on labels. So there's lots of names, lots of labels, and you'll, in any textbook that you open on technical analysis, you'll see this a lot. So you'll see head and shoulders, you'll see double tops, double bottoms, cups and handles, triangles, hammers, dojis, etc., etc., etc. Now, point is, will remembering all these names make you a better trader? Unfortunately not, because labels don't make you a better trader. What makes you a better trader is being able to read the markets, so being able to read the price action. And the most important thing that we get from a chart, the most important information that we get from a chart is the price action itself. So what we need to be able to do is to look at a chart and read the price action and read it to tell us, which tells us, which way the market is moving. And by the way, guys, everything else that's there on the chart, apart from the price action, is actually the icing on the cake, and is actually derived. And one thing you must always remember, that everything else that's there on the chart, be it the moving averages, be it any indicators that we use, they're all basically derived from the price action. So price action is the purest form of information that we have, and the most important information that we have from a chart, and we need to be able to read that. So what I'm trying to get at also is that the labels around it, the names that one gives to these various chart patterns or what have you, is not important. It's simply being able to look at it and understand this information without necessarily memorizing the labels. So what does really matter? What is the important information that we need to focus on when we read a chart? So the first thing is, who's in charge? Is it the bulls? Is it the bears? And when we look at each candle actually tells us a story. It tells us what happened in a particular session. Who won? Did the buyers win the session? Did the sellers win the session? Or was the session a draw? And we can just tell that by looking at the candle, and it tells us whether the buyers were in charge, sellers were in charge, or was it an indecisive session. So these are important things that we need to know from a chart. Who's in charge? Who controlled each candle? And of course, this is actually the most important thing in trading, is knowing the trend. So, and reading the trend from the price action. So first of all, just by looking at a chart saying, is there an uptrend, is there a downtrend, or is there no trend in place? And I know it sounds sometimes quite basic, and sometimes trends are talked about in the first chapter of any book on technical analysis. So people look at it and they see how trends are drawn out, and then they forget about it. And that's a big mistake that people can make, because just based on two things. So based just on trends and being able to read trends, and just being able to read sort of support and resistance and construct support and resistance on charts, just these two things, where one can actually construct a trading strategy just around these two. But I'll come back to that in a little while. So knowing if there's a trend. The other thing is, when we use indicators, and one needs to exercise a little bit of caution, because indicators can often be used in a lagging way, and that's no use, because we need to use indicators in a leading way. At the end of the day, it's very easy to read the left side of a chart, because I can look at something that's already happened and I can say, I should have done this, or this is the action that I should have taken, I should have bought here, should have, would have, could have, and that doesn't help. What we need to do is we need to trade from the right side of the chart, the hard right of the chart. And to help us to do this, we need to use indicators in a lagging or in a leading fashion. So we need indicators that predict, not lag the price action. Of course, we talked about trading strategy and how we can combine different elements of technical analysis to use in a trading strategy. So what does this trading strategy do for us? It defines basically the precise entry, where to set our stops, and what is our target. So it does these three things. It decides the entry, the stop, and the target, and that's what a strategy helps us to do. Let's quickly discuss the anatomy of strategy. So what makes a strategy? What is a strategy? So a strategy basically is nothing but a set of rules which defines in advance our entries, our exits, where to set our stops, and our profit targets. And it does so in a manner that gives us an edge in the market. How does it give us an edge in the market? Basically, it gives us an edge in the market by loading the probabilities in our favor. So therefore, we look at different factors of technical analysis, each of which gives us an edge, a little bit of probability, and when we take several factors and combines them together, then the probabilities add up, so they're additive, and that increases the probability or the chances of our success, and therefore gives us an edge in the market. And obviously, a strategy helps us to plan out the trade before it actually happens. What we're looking at with the strategy is we're looking at things that happen in the market with some amount of consistency, and we're looking to exploit the fact that events in the market tend to occur and recur. So that's exactly what we're looking at with technical analysis. When we read price patterns, when we read a chart, when we apply a technical analysis, that's what we're looking at, and that's what a technical strategy essentially helps us to do. So I just spoke about this. So what we do is we use repetition in the market, and that is what helps us to achieve consistency. So the other thing that we spoke about, and this is of course very, very important, is to be able to control our emotions and to bring a positive mindset to the table, which A, allows us to be disciplined, and B, allows us to bounce back from a string of setbacks which do happen from time to time. And the important thing is to focus on execution, so executing flawlessly and executing consistently. And of course, emotions and a positive mindset helps with this as well. And profitability, by the guys, happens as a byproduct. So if one is able to trade well, one is able to bring consistency to the table, one has a proven strategy, and one applies the proven strategy consistently, then profitability all follows. It follows as a byproduct of that. Right. So what we'll do now is we'll briefly introduce one of the strategies that we use. Strategy that we use in our trading rooms. But before we do that, let's talk about the ingredients that go into this strategy. And there are three. So the first thing is trends and being able to read trends. The second thing is being able to identify support and resistance. And like I said, just based on trends and support and resistance, often many trading strategies can be designed. But the other thing that we need to look at also, and this is equally important, which is risk management, because risk management ensures longevity, of course. So let's look at these ingredients and let's look at how we can construct a strategy using these three ingredients. So the first thing is trends. So what is a trend? Now, again, like I said, it's not difficult, it's not hard, and it's just sometimes it's sort of so basic that people don't pay a lot of attention to it, but in my opinion, a very important part of trading, which is so being able to recognize a trend. And here on the left, we have a chart which is an uptrend, and simply I have a couple of questions coming through. And I have a question from Ronald, who asks, should we listen to the market news for trend support also? Well, look, whether you listen to the market news I suppose listening to the market news or not is something that one can't help or avoid. And one is bombarded by the media, whether it's news on television or on blogs or on the internet. But what technical trading is not about it's not about trading the news per se. So what technical trading is all about is purely looking at the price action and being able to read the market by looking at the price action. And this is what I just spoke about some time back, that the most important information that one has, and that is what all technical analysts believe, is the price. And so we need to be able to look at a chart and assess which way the market, what the market is likely to do by looking at the chart. So irrespective of what the news may or may not do. So as a technical analyst, you don't really believe well, you can trade the news, and there are ways in which the news can be traded, and we can discuss that as well. But the primary source of information for a technical analyst is always the price action. So just coming back to trends, what we're looking at when we look at a trend is we're looking at a series of higher highs, as we can see here with these red circles. So this is a series of higher highs and a series of higher lows. So when we have a situation which is a series of higher highs and a series of higher lows, and so therefore it's not complicated, you have an uptrend. And on the flip side, when you have a series of lower lows and a series of lower highs is when you have a downtrend. So not complicated, but and quite basic, but something that is very, very important as far as trading is concerned. So the other thing that I spoke about is support and resistance, and trends. Just based on these, like I said, you can often form a strategy. So what's true resistance? True resistance is when prices reach up to a flat level or a horizontal level and bounce off that level. And there are two or more touches within a certain number of ticks, like you can see in this instance. So there's one touch, there's an approach there, and another touch there. So it's not a touch and a breakthrough. So if it touches and breaks through the level, then that's not really a level of support and resistance, but it's a level of resistance when there's a touch and an approach, for instance, or another touch, and a bounce back from that level. So when prices reach up to a level, are not able to penetrate, and touch that level more than two or more times within a certain number of ticks, then you have a true resistance. And the converse is true support, when prices reach down to a level of support and bounce off that level once or twice, at least twice within a certain number of ticks, then you have a level of true support. So just to clarify, and this is what I was speaking about earlier, when you have just one touch, as you can see in this instance, this is not really true support. This is called trend resistance, or in some instances it's called like a swing high, or in the case of a downtrend you can see trend support, or sometimes called swing lows. So here you just have one touch and a breakthrough, one touch and a breakthrough. So this is not really true support, as we discussed in the previous slide. So one thing about support and resistance is that when resistance gets broken, resistance often becomes support. And when support gets broken, support becomes resistance. And this happens with unfailing regularity in the markets. Why does it happen? It happens because of market memory. So, traders remember points where the market sort of retreated from, and they either set entry orders at that level, which either causes a reaction away from that level or in either direction. So it can cause in the case of a resistance, it causes a reaction back. In the case of a support, it causes a bounce, and that's the same reason actually it even causes a break. So, but that's the reason why resistance becomes support and support becomes resistance. The other thing is, one other thing I'd just briefly like to touch about, and this is talked about a lot in traditional technical analysis, is that of sloping trend lines. And there'll be usually in most technical analysis textbooks, there will be almost a whole chapter dedicated to this. So the problem with sloping trend lines, guys, is that they're very, very subjective, because and according to the definition of trend lines, what it is you join 2 points of a trend together, and that forms a trend line. So for instance, in an uptrend, you join two higher lows, as this line here does, or in the case of a downtrend, you join two lower highs, as is done here. So then it becomes very subjective, because one person's uptrend can be another person's downtrend, and one person's trend can be other person's trend. And how do you define a trend? For instance, by the definition of a trend line here, you have a trend line that's drawn where I'm hovering my mouse, but as we can visually see, is there really a trend there? Not really. It looks like the market's going sideways. So is there a trend or is there not a trend? That's the first thing. Second thing is there an uptrend or is there a downtrend? So here we have a line that's drawn that shows an uptrend, but on the same sort of price action, you have these lower highs that are joined together, and so that could be somebody else's downtrend. And this is the biggest problem with sloping trend lines, is that they can be very, very subjective. So because of their subjectivity, it's often they're often best avoided. So let's talk about this specific strategy that I was talking about, and the recipe that it consists of. And this is actually a condensed version, to be honest, of the strategy. Is there are 4 parts to it. So the first thing is, what do? We trade breaks, and we trade breaks above or below a level of support and resistance. So a flat level, which is a horizontal support or resistance level, and we trade breaks above or below these levels of support or levels of resistance. Which direction do we trade in? We trade in the direction of the trend, and we place our stops. How do we place our stops? We place our stops logically so that they are protected by strong price action. And of course, we don't risk more than 1% of our capital, of our trading capital, on each trade. So let's just go through this in a little bit more detail. So the other thing that we use in our strategies quite a lot is we use moving averages. So we use moving averages as leading indicators, not as lagging indicators. So we don't use them we don't use moving average crossovers, or we don't use prices going above or below a moving average or touching a moving average to indicate an entry or an exit. But we use moving average as a leading indicator, and we'll discuss a lot more of this in the advanced education course. We use trend analysis, of course, which tells us when to trade and when to stand aside. We use candle patterns, of which we say there are just 3. So basically, is a candle a bullish candle, is a candle a bearish candle, or is a candle an indecisive candle? And those are the only 3 that one needs to remember. In terms of chart patterns, the only thing that one needs to remember is what is an optimal chart structure, and that's what we use with our trading. Then the other thing that we talk about is using multiple time frames. So not just trading off one particular chart, but also using higher time frames to confirm one's reading. we use indicators, momentum indicators, and the way we use them is we look at convergence and divergence of a momentum indicator with respect to the price action. But the important thing to remember is what I said earlier, that the momentum indicator, we must remember, is calculated from the price. So the basic piece of information that we have is the price, and we need to remember that the momentum indicator is derived from the price, and therefore just the icing on the cake and helps us to confirm trend direction or the strength of a trend. So let's look at an example of this strategy, and as we can see, here's a chart. So first thing is there a trend? So on the right side, clearly we can see that there is an uptrend, as you can see with the black zigzag lines that I've drawn out. So yes, there is an uptrend. Is there a flat level? Well, if you cast your eye to where the 86, where you can see the number 86 or the 86 level on the chart, and clearly you'll see there is a flat level which has been touched or approached several times within a few ticks in the past. So there is a flat level at that level. Now, there is some information that's missing on this chart. What information is missing? What we don't know, what this chart doesn't tell us, is it tells us nothing about what the momentum indicators, and we use two momentum indicators, by the way, guys. So what we use is we use the MACD and the RSI, and both the MACD and the RSI are not there in this chart, so we don't know what they're indicating and what the strength of the trend is. So the other thing is, what is the risk? Can we tell from this chart? Yes, we can. Where is the risk? The risk is simply where we set our stop losses. And as we can see, and where do we set our stop losses? We set our stop losses at the point that is most logical, or the point at which our assumption of an uptrend would be wrong. So right here where the red dotted line is where if the price action broke through below this line, is where our assumption of a series of higher highs and higher lows would be invalid. So our assumption of an uptrend would be invalidated, and therefore the point at which we would be proved wrong. So therefore that is the point at which we set our stop loss, and where we set our stop loss is our risk on the trade. And here we see, okay, our reward is potentially 1.5:1, but when we're looking at the reward, the thing that we look at is, are there obstacles or are there any hurdles on the way to our reward or our target? So if there was, for instance, a line of resistance on the way to our target, then the potential reward would be lower, and we take the potential reward below the level of resistance. But in this case, let's assume there's no resistance, so we can assume that the potential risk to reward is 1.5:1, which makes for a very good trade. So in this instance, okay, there was no resistance on the way to the target. We entered the trade and the trade target was reached. Now, one thing that I must point out, especially in the case of binaries and in the case of your trading with Nadex, is you can lock in your profits using limit orders. How can you do that? Is so if you go long, you can close out a long position by entering into a short position, and if you enter a limit order with a if you for instance, if you buy a contract with a target of and you believe that the target is 88, at the same time, if you enter an offsetting contract with a limit order, so you enter an offsetting contract which is a sell contract with a limit order at 88, that helps you to lock in your profits at 88 on the Nadex platform. Okay, so another example of a momentum strategy, and let's look at it with respect to our checklist. So first of all, is there a trend? And clearly we can see, yes, there is a trend. What is the trend? The trend is up. Is there a flat level? And we see, yes, there is a flat level. So what does the flat level do for us? It defines our point of entry. So in the case of a binary option, it would basically define your strike price, or the price that you got into a contract, a binary contract, is what this flat level would define. Let's look at the MACD. Here we have the MACD and the RSI drawn out. Is the MACD convergent? And it appears that the MACD is convergent, or more specifically, to be more correct, it is not divergent. And if it's not divergent, it is convergent. It is convergent. Is the RSI convergent? Again, it is not divergent and therefore convergent. Is the stop protected? So where do we draw a stop? We draw a stop right there. Why? Because if the price action were to come down below that point, that is when our assumption of an uptrend of a series of higher highs and higher lows would be invalidated. And so therefore that is the point at which we draw our stop loss. And is there a good risk to reward? In this case, at least a 1:1 risk to reward ratio does exist. So the trade got triggered and it went through and it reached its target in this instance. Now, this is another example of a short trade in which is on the 15-minute chart. And again, is there a trend? Yes, there is. Is there a flat level? And as we can see, there's a flat level right there. Are the indicators convergent? And we can see clearly in both cases the MACD and the RSI are convergent. The risk is where we set our stop loss, and the potential risk reward did in this case trigger as well. And not only triggered, it actually reached twice the profit potential. Though before going through to the profit potential, it did bounce around the flat level, which would have given us a little bit of a hard time, I suppose. But the important thing is, because all these signals were convergent, so we took the trade and the trade worked out in our favor. So before we end, let's also quickly talk about the different advanced education courses that are there in Nadex. So basically, the advanced education courses are presented in 3 installments, and they're presented by Trade with Precisions. The value of the courses is it's at least $500, but it's free of charge for all Nadex clients. And just like this webinar, it's actually conducted live for all Nadex members. In the first webinar, we actually talk about in detail how to implement technical analysis and the most reliable technical analysis tools, how to read price action, and what is the difference between the different styles of trading. So the difference between swing trading and day trading. And we also talk about what technical ingredients to focus on and what to ignore. In part 2, we actually talk about how to use multiple time frames to stack the probabilities in our favor, and we discuss 2 trend following strategies. And we talk about these strategies in a lot more detail than we did today. So today we talked about the momentum breakout strategy, and in these webinars we talk about momentum breakout and the trend flow strategy, and we talk about them. So we talk about how these strategies work, how to define your entries, how to define your exit, and where exactly to set your stop losses. And in part 3, we go into live charts, and we do a little bit more practicals, and we see these trades or see these strategies in action. And we also discuss how to trade gaps, how to trade the news, and things like that. And this is in line with the question that we got from Ronald. And I have a question here from Juan, who asks, is it better to focus on only one strategy or to try different strategies? Well, the thing, Juan, is it's important to not to have, it's not like, you have one strategy today and one strategy tomorrow. So what you need to have is, or one needs to have, is a proven strategy that works, and then to apply that strategy consistently. So yes, it's important to have just 1 or 2 and hone down and select one strategies and be comfortable with the strategies that one applies. But the important thing is, A, having confidence in the strategy, and B, then applying those strategies consistently and executing the strategy flawlessly, which is what makes one successful. So we spoke about this in terms of using the TWP strategies, the strategies that we will talk about in the advanced education seminars, which allow you to trade with a fixed amount of risk and allow you to evaluate the risk-reward ratio prior to entering the trade. So in summary, and I've been speaking about this throughout today's webinar, is about having a strategy and about executing the strategy flawlessly. It's about managing the rules and having rules first of all, and then managing and sticking by those rules and sticking to your money management rules especially. And what a strategy does is it gives one an edge in the market, and obviously it gives one an edge provided one takes this or applies the strategy consistently over a large enough sample set. So I hope that answers your question as well, Juan. And there's a quote here from Jesse Livermore, who basically says, Wall Street never changes. The pockets change, the stocks change, but Wall Street never changes because human nature never changes. So that brings us to the end of today's webinar, and I've gone over time by about a few minutes. So if there are any questions, I'll stick around for a few moments. If there are any more questions, please send them through, and we'll try to go through that. If not, thank you. You've been a wonderful audience, and I'll see you again in the next webinar. Also, just like to highlight that there will be, when I end this webinar, there will be a brief survey. So if you could please fill in the survey and send that through, that will be most useful, because that's what we use to help us improve, and it tells us how we're doing, what changes we need to make. So please do fill up the survey that you'll see at the end of this webinar. So if there's no more questions, I'll end this webinar now. Thank you. Okay. There's a question here from Richard, who's asked this question on sloping trend line. Yeah, the problem, Richard, with sloping trend lines is that sloping trend lines can be very subjective. So, and this you will see if you try to draw trend lines on any chart. So you pick up a chart and try to draw a trend line, and you draw it once, and the next time around you draw it, your trend line might look a bit different from the one that you drew the first time. So even for one particular person, the trend line that is drawn one particular instance to the next particular instance can be a little bit different. And so the other thing is, obviously, trend line drawn by one trader can be a little bit different from another trader. And therefore, and that's one of the biggest problems with trend lines, is that they can be subjective. So because of their subjectivity, that is why they're not that effective. And often, a lot of people think of trend lines as dynamic sort of support lines or dynamic resistance lines, and we don't really subscribe to that view because of their subjectivity. Okay, John's asked a question on how do you enter the advanced course. So all you need to enter the advanced course is you need a live trading account with Nadex. So as long as you're a Nadex client and have a live trading account with Nadex, you can just go on to their platform and you can register for the advanced course. And and it's obviously free for all clients of Nadex. So if you don't have and I'll talk a little bit about that. So if you don't have an account with Nadex, then as you can see, the information is put up here. So you can just go to the nadex.com website, and you can click on the right on the orange box saying sign up, and you can just complete your details, and we will get back to you via email. Or if you're a current member, then you can just log on to your account and commence trading, and just are welcome to come to this webinar. All right, guys, looks like all the questions have dried up. So thank you very much. Thank you. You've been a wonderful, wonderful audience. Thank you very much. And may I please request you to please fill up the the survey form. And that, because that's what helps us to improve. Thank you. Thank you very much.